Stop scrolling. Put that candlestick chart down and listen. If your entire silver stack weighs less than your house cat, you can probably ignore this. Everyone else, eyes up. The price you see glowing on a screen tonight might not be the price that buys you real, solid metal tomorrow morning. Paper silver trades in milliseconds. Physical silver moves in trucks, planes, and very real queues. When those two worlds separate, fortunes can be made and mistakes get expensive, fast. We are on a 24-hour clock, and the window of opportunity can slam shut while you're asleep. Here's the 10-second snapshot of why tomorrow matters for you. As of Thursday, January 29th, 2026, here are 3 facts in 30 seconds. 1. Physical premiums for popular 1-ounce coins at major U.S. dealers just ticked up. 2. COMEX registered silver sits at a very thin cushion versus the amount of open interest. And 3. Shanghai spot is paying a significant premium to London. What does that mean in plain English? The real-world checkout line for silver is getting longer, while the paper tape on your screen looks deceptively calm. That's a divergence you cannot ignore on a 24-hour clock. But there's one number that really decides whether we spike or fade in the next 24 hours. Here's the single dial that anchors everything. The Shanghai-London spot spread. Real buyers are outbidding the paper market, and your screen is lagging behind the cargo ships. My playbook is simple. If that spread remains high into the Asia close and the London fix, my bias is to the upside. If it compresses, I expect a fade or choppy price action. You can verify this yourself with public data from the SGE, the LBMA, and the CME. When simple arbitrage can't explain a premium, the underlying market mechanics matter more than the headline price. If that gap isn't closing, it means something is blocking the flow of metal, credit, custody, or margins. Banks and market makers can mint paper silver in seconds, futures, forwards, swaps, while real bars move at the speed of a refinery. A tiny margin tweak can kick out week-long positions, and the selling pushes the screen price down. Meanwhile, mechanisms like EFPs shuttle risk over to London, diffusing any immediate delivery pressure. ETFs can absorb massive inflows without yanking a single bar from a vault, so on paper, demand looks satisfied. But here's the reality. COMEX, registered inventory, is thin. Refiners face bottlenecks producing the right kind of bars, and coins can't magically become good delivery bricks overnight. The incentives are all aligned for the big players. Banks monetize the spread, the CME sells trading volume, and the media sells you headlines. The trap is simple. The price is discovered where claims are cheapest to issue, not where the metal is scarcest to ship. So while retail waits, industrial users are bidding up the physical price and inventory slowly drains. If the price on your screen disagrees with the price at the coin dealer's counter, trust the counter. Let's put these two worlds side by side. The physical market is loud. The paper market is quiet. At the dealer counter, high coin premiums, multi-day shipping delays, and rising buyback bids are all screaming that demand is real. On the screen, the spot price looks orderly, and ETFs show tiny deviations from their net asset value. The East is pulling metal, while the West is just referencing a paper price. China's SGE is paying a premium over London. India's imports are surging. Meanwhile, LBMA vaults are holding a certain amount of inventory. Here's the truth versus the headline. The world that ships metal is getting tight. The world that prices claims is calm. When those two pictures diverge this much, the tape can snap back to reality, fast, maybe even overnight. The only question now is how fast and what breaks next. Yesterday, the SGE-LBMA spread printed at a certain level. COMEX registered, sat where it was, and the SLV ETF saw holdings fall. That set the tone. Physical demand was outbidding paper, while screen-based liquidity stayed complacent. Today, the spread is holding, registered inventory is still tight, and we're watching for any sign of a CME margin notice. If credit tightens or margins rise, week-long positions will get ejected and the market will whipsaw. Next, we roll into a major market event in just a few hours, where liquidity thins out and algorithms will chase whichever market blinks first. Your tripwires are simple. Watch for sudden dealer stockouts, any mint rationing updates, and any headline about margin hikes or delivery hiccups. The clock is running. Asia, London, and New York are compressing into one single tradable heartbeat. So, here's the 24-hour playbook. Bull, base, and bear scenarios. First, the base case. If the Shanghai-London spread holds strong, the dollar index stays flat, and bond yields are steady, expect a slow drift higher, maybe 0.5% to 1.5%. Momentum will hand off from Asia to London, and inventory stress will lift bids into the New York Open. It's a grind, not fireworks, with dips getting bought up while retail premium stays sticky. Now the upside shock scenario, a big inflow into an ETF like SLV with no change in margin requirements could force shorts to cover into a thin market, stretching a move to 2 to 4% within hours. The basis would tighten, offers would vanish, and the screen price would chase the physical price as dealer shipping times extend. And the downside flush, A surprise CME margin hike or a sudden jump in the dollar index could knock the price down 1 to 3%, but we'd likely see a rebound as physical bids reappear at lower prices. The danger zone is the handover from the London fix to the New York pit open. So what should you actually do with this information? If you already hold physical metal, think in terms of premiums, not just the spot price. Track what dealers are asking versus spot and what they're offering to buy it back for. Call them and confirm real quotes. Don't panic swap your coins for paper unless the distortions become extreme. Verify your metal, tighten up your storage, and keep a small cash buffer. If shipping times stretch out, scale in calmly rather than chasing the price. For ETF holders, watch the daily creation and redemption numbers and any gaps between the fund S price and its net asset value, especially when retail premiums are spiking. Understand how your ETF sources its metal. If holdings expand into strength, that's squeeze fuel. If they leak while the price rises, that's a warning. Plan your exits during liquid hours. Don't let market gaps choose for you. For futures and active traders, expect volatility. Size down into major events, respect the calendar spreads, and place your stops beyond obvious liquidity sweeps. A margin change can force you flat, so have a plan. And for beginners, start with simple, low-premium products from reputable dealers. Understand the difference between spot price, premium, and shipping time. Keep your receipts, test with small amounts, and build good habits before you build a large position. This is for education only, not financial advice. Skeptical? Good. Let's hit the number one pushback head on. Arbitrage should close these gaps overnight. On paper, yes. But in the real world of 2026, constraints slow that loop down. Shipping and credit limits cap the size of arbitrage trades. Refiners face mismatches because retail coins are not the same as the good delivery bars traded by banks. Taxes, VAT, and compliance add friction. High interest rates raise the cost of carrying inventory. And a surprise CME margin hike can nuke a position mid-journey. We've seen this before. The gold and silver dislocations in March 2020 lasted for days, and the 2022 nickel market blow-up shattered textbook arbitrage timing. So yes, arbitrage exists, but no, it doesn't move at the speed of Twitter. That spread can persist. Here's your dashboard to navigate the next 24 hours without guessing. Our sources are all public: CME warehouse stocks, CFTC data, LBMA vault data, SGE and SHFE prices, iShares LV daily holdings, US Mint sales, and official import-export data. We are timestamping all data to January 29th, 2026. Let's recap. The killer metric is the SGE versus LBMA premium after you account for real-world friction. When it stays wide, the physical market is winning and the paper market is lagging. Tomorrow's bias is up if that spread holds and margins stay steady. The bias flips down if the spread compresses or the CME hikes margins. Watch the Asia close, the London fix, and the first 30 minutes of the New York Open. If this helped you understand the market better, subscribe to Money Mind Hub and hit the alert bell for our next emergency bulletin. Then comment below with your local premium and what your dealer's shipping time is. Share this video and catch our next deep dive into COMEX delivery data. A quick disclaimer, this content is for educational and entertainment purposes only. It is not financial advice. We are not licensed advisors. All data is from public sources under fair use. Always do your own research and invest at your own risk. We are not liable for any losses.